The dip is coming, so you wait. Then it drops more, so you wait longer. Then it rockets up without you. I am going to show you exactly why buying the dip fails most investors with real numbers. Most investors lose not because they pick bad stocks. They lose because they are stuck waiting for the perfect dip, waiting while the market climbs without them. I'm going to show you the exact numbers that prove why waiting is the most expensive habit in investing and what to do instead.
2 strategies, 1 question. Which one actually builds more wealth? Dollar cost averaging is the simple one. Fixed amount, fixed schedule, every single month, no matter what the market is doing, you invest. $500 on the first of every month into an index fund. Market up, you buy fewer shares. Market down, you buy more. Your average cost balances out automatically. No decisions, no stress, no watching charts at midnight. Just consistent investing, running whether you are paying attention or not. Buying the dip is the other approach. You hold cash, you wait for prices to drop, then you swoop in and buy stocks at a discount. It sounds disciplined, it sounds smart, it sounds like exactly what a serious investor would do. But here's the real question nobody asks. What happens while you're waiting? The market does not pause for you. It does not send you a notification when the bottom is in. Every day your cash sits there. The market might be moving without you and never coming back to where you were waiting. That's not a theory. We have 20 years of data that proves it. But first, let me show you how this plays out in real life, because I want you to see yourself in this story. Meet Alex and Jordan. 2 friends, same age, same income, same goal. Build wealth through investing. At the start of the year, both have $6,000 ready to go. Alex does not overthink it. $500 first of every month, straight into an index fund. No news, no waiting, no strategy. Just automatic, consistent investing. Jordan is different. Jordan has been reading. Jordan has been watching. Jordan knows that if he waits for a 10% drop, he can buy everything cheaper. So he holds all $6,000 in cash and waits.
January comes. The market starts falling. Jordan watches closely. By March, it is down 8%. Jordan thinks, almost there. Let me wait for 10. This could get worse. And here is where the pain starts. A strong jobs report drops in April. The market stops falling and starts climbing, fast. Jordan watches it bounce off that 8% low and push toward new highs. His 10% dip never came. By July, the market is above where it started. By December, record highs. Jordan never bought. $6,000 sat in cash the entire year, earning almost nothing, while Alex was fully invested and growing. But Jordan's story gets worse. This was not a one-time mistake. This became a habit. Year after year, Jordan found a reason to wait. Year after year, the market moved without him. Jordan is not stupid. Jordan is not careless. Jordan is human. And this is exactly what happens to millions of perfectly intelligent investors every single year. Charles Schwab tracked 5 investors over 20 years, from 2003 to 2022. Each received $2,000 every year to invest in the S&P 500. Same money, same market, 5 completely different results. Pay attention, because one of these is going to hit you hard. Investor 1, Peter Perfect. He invested at the absolute lowest point every single year. Perfect timing, 20 years straight. His result? $138,000. Now remember that number, because here is where it gets interesting. Investor 2, Ashley Action. She invested on January 1st every year. No research, no timing, no strategy whatsoever. Her result, $127,000. Only $11,000 less than perfect timing over 20 years. Think about that. Perfect timing, the kind no human can actually achieve, only beat doing nothing on January 1st by $11,000 over 2 decades. Investor 3, Matthew Monthly. He split his $2,000 into 12 equal monthly investments. No timing, no lump sum, just steady automatic DCA every month. His result? $124,000. Never stressed, never decided, just invested and let time do the work. Investor 4, Rosie Rotten. She bought at the absolute market peak every single year, the worst possible timing, every year for 20 years. Her result? $121,000. Even terrible timing beat doing nothing because she stayed invested. And now, Investor 5, Larry Linger. Larry was the smartest one in the room. Larry watched carefully. Larry waited for the perfect moment. Larry kept his money safe in cash, convinced the right opportunity was just around the corner. His result after 20 years? $44,000, less than a third of what the worst timer made. Not because the market failed Larry, but because Larry was never in the market long enough for it to work. The gap between perfect timing and worst timing? $17,000. The gap between worst timing and sitting in cash? $77,000. Waiting did not protect Larry. Waiting destroyed him.
Now here is the part nobody talks about, and this is the most important part of this entire video. Why do smart people keep making Larry's mistake? Why does buying the dip, a strategy that sounds completely logical, fail almost every investor who tries it? The answer is loss aversion. When markets are rising, you feel fine. Easy to say, I will buy when it drops. Feels rational, feels smart, feels disciplined. But the moment the market actually drops, something changes inside your brain. News turns negative, friends start panicking, your portfolio goes red, and suddenly your brain does not see a discount, it sees danger. Humans feel losses roughly twice as intensely as equivalent gains. This is not a personality flaw, this is biology. And it means the exact moment you are supposed to buy the dip, when prices are low and the opportunity is real, is the exact moment your brain is screaming at you to do the opposite. DCA bypasses this completely. The money moves automatically. No courage needed. No market confidence needed. The system runs without you, buying more shares precisely when prices are lowest, whether you're watching or not. Warren Buffett did not accidentally recommend this for the vast majority of investors. He said it because after 60 years in markets, he knows the enemy of good investing is not bad stocks, it is the investor themselves.
Now, one last thing. DCA and buying the dip are not always enemies. Many smart investors run a core DCA strategy that never stops, but also keep a small opportunity fund on the side, maybe 5 to 10% in cash, not to wait endlessly, but so that if a genuine major crash happens, they can deploy that extra cash and accelerate their position. DCA runs regardless. The opportunity fund is a bonus, not a replacement. What you want to avoid, what Larry represents, is using "I will buy the dip" as a reason to never invest at all. The data is clear. Being invested with terrible timing beats sitting in cash by $77,000 over 20 years. The market does not reward patience, it rewards presence. Start now, invest regularly, do not stop. The best time to invest was 20 years ago. The second best time is today, not when the dip comes, today. If this video helped you, hit the like button right now. Subscribe for more videos that break down real investing concepts with real data in plain language. Drop a comment below. Are you a DCA investor or have you been waiting for the dip? I read every single one. See you in the next one.